One, they want to keep your money in the market, or two, they just simply don't know. But the secret that the Rockefellers had and used is human life value. And we're going to get into what that means today. And all of you on the call, eventually, we're going to show you the formula to determine what is your human life value, why you want to have human life value as a part of your life, as a part of your financial planning. It's an awesome secret, but think about this. How much pressure would you feel if your home burned down and you didn't have insurance? What would that feel like to you? How would it affect your family? How would it affect your finances? How would it affect your future? Your life is worth far more than your home. Yet most people protect their home better than their greatest asset, themselves. We want to show you how to protect yourself in a way that makes financial sense. And look, not only are you your greatest asset, think about you as your greatest asset and what that allows you to do in your life for you, your family, right? Because without you, there's no job. Without you, there's no income. Without you, there's no home. Without you, there aren't the cars and the toys and the vacations. We are our greatest asset. We want to be in a position where we are protecting ourselves, but also ensuring, like the Rockefellers did, that we can leave an amazing legacy and propel that wealth on and on and on.
All right. This is good stuff, Barry. I want to welcome anyone that's jumping on right now. We've got a pretty good number of people just jumping on. If you guys have questions during the webinar, you can leave them in the chat and we'll try to answer them on the fly. If we can't get to them, we may have to answer them at the end. So just know that we'll try to answer all questions today, being that it's the live webinar. The other thing I want to mention is that human life value is a very important concept to me as a career trust and estate attorney. It's one of those things that I observed that certain people took seriously and the rest of the population didn't. And there's a lot of advice about buying cheap term and these kinds of things. And think about that. Buy the cheapest thing you can to protect your human life value. On its face, doesn't seem very wise. So really looking forward to jumping into this, Barry, and I'm looking forward to seeing these perils and risks in the way that you explain it for everybody here.
Yeah, we never want to be in a position if our home burns down and we don't have any insurance to cover it. Insurance allows us risk management. We're transferring the risk to a professional insurance company that day in and day out manages that risk. We don't want the worry. We don't want to have to deal with the financial consequences or emotional consequences of not transferring the risk. But there are other perils and risks that we're going to just briefly talk about. What if there's a loss of health? Health is huge. I know a lot of very wealthy people that don't have good health. So how do you protect against the loss of health? Or what about loss of income? There are insurances that we have that can protect against loss of health, loss of income. But what about investment loss? Many people went through the crash of 2008. We even saw some of that happen in 2020 with COVID, that you can see portfolio values erode, 401ks, IRAs, your brokerage account. There's investment loss that can be a risk that you have in your life. Taxes, this is like a ticking time bomb because we don't know 10, 20, 30 years from now what tax rates will be. What are you doing to protect yourself from unknown future taxes? We're going to get into some of that today. And what the Rockefellers did to protect against those unknowns of taxes. And then also premature death or late death, right? We might all live to be 90 plus years old. But Steve, recently I've had two clients pass away just in the last 4 months. One was 39 years old. The other was 51 years old. Those are premature deaths. We want to plan for those perils as well. The Rockefeller family, go ahead.
Yeah, I just want to mention one thing about taxes. It's like, if each one of you guys were given the chance to take a mortgage out, but you wouldn't know the interest rate for 20 years, would you think that that was a good deal? To your point on taxes, Barry, there's a lot of uncertainty down the road that I know you're going to get into. So I just want to tease that point. It's a very important point.
That's right. And we all want to benefit positively from a tax perspective. There are ways to do that. Most of us aren't taught those correct ways, but this is one of the things that the Rockefeller family knew. They also utilize cash value life insurance in their wealth management strategy. And here's why. They want to perpetuate generational wealth and transfer it, ensuring the assets are preserved and transferred efficiently to future generations. They also use family trusts. Cash value life insurance policies are linked to family trusts, allowing wealth to be accumulated and managed across generations. And what I want to emphasize here is across generations. The comparison that we've seen, the Vanderbilt family didn't use this strategy. And across their generations, they lost wealth because family members would just spend money, or they didn't have the trusts in place, or they didn't have the cash value insurance in place. And family wealth gets distributed, it gets spent, it gets lost. The Rockefeller family also was very thorough on estate planning. And you know this, life insurance death benefits are used to pay estate taxes, ensuring the family business doesn't need to be sold. Now, today, the estate tax is about 25 million for a couple. So if your estate is over 25 million and you pass, there will be about 50% estate tax due on that money, but you can use life insurance. There's a life insurance trust called an ILIT, irrevocable life insurance trust, that allows you to pay estate tax without your family having to either sell a business or sell assets, or we know some horror stories selling a baseball team or a football team, right? And these are things that resonate with you, Steve, as an estate attorney.
Right. And, Barry, you're pointing out that trust planning and using this asset the way the Rockefellers did, they go hand in hand. And it was one of the things that led to starting up Insurance and Estates about 8 years ago. And we are striving to offer now, after a lot of development, we're offering some trust planning and things. So I just want to make people aware of that. They can check into that. But the point is that these things can be very much more successful if you combine the trust planning with the strategies that you're going to reveal. So I'm glad you're pointing it out.
Yeah, and remember, everyone stay tuned because we're going to show you the formula to determine your own human life value and why you would want human life value in your overall plan. Last thing we'll share here about the Rockefeller family utilizing cash value insurance is they wanted a family banking concept. This system, the cash value in the policies is used as a family bank where family members can borrow money throughout their lives. There are protocols you can put into place to make sure the money's paid back, etc. So all these things are a part of the Rockefeller family, and you can have them too. It's not complicated. We like to keep things very simple, but you can have these things too to perpetuate your own wealth while you're alive, but also perpetuate family wealth generationally. And don't we all want that? Steve, May 1st, I became a grandpa. My first granddaughter, first grandbaby born with May 1st, just a short time ago. It's changed my perspective a little bit on thinking about family generational wealth. Now that I'm a grandpa, I'm like, hey, this is real. I
Yeah.
do want to leave more generational wealth to my kids, grandkids, future great grandkids, and so on.
And at age 39, that's amazing.
Love that. Thank you. Thank you. So let's get into the numbers. We're going to look at these are real life illustrations with some of our top mutual insurance companies. And we're going to break things down by a person's age. We're going to look at a 35-year-old, a 45-year-old, a 55-year-old, a 65-year-old. So I believe all of you listening out there, there will be a scenario here that is going to fit your scenario pretty close. But before we get into the whole life numbers, there's this big myth out there that you should buy term insurance and invest the difference. Because what we're looking at right now is $1 million death benefit on a 35-year-old. And the premium for this would be $13,750 a year. And some of you are saying, I'm not going to spend $13,000 a year for $1 million death benefit when I can spend far less money if I have a term insurance policy. But let's see the reality of this. And I want to debunk some of the myths of buying term insurance and investing the difference.
I have no idea where that myth comes from, Barry, as you say that. No further
Yeah,
comment.
Wall Street, we know, financial advisors. Because look, those companies, Charles Schwab, Merrill Lynch, JP Morgan Chase, Fidelity, Ameriprise, Edward Jones, they want your money in the market. So they're going to tell you buy term insurance, invest the remaining portion of your funds into the market. Why? Because we're going to earn the fees. We're going to make money every year. Even if you lose money in the investments that we recommend, we're still going to make money. So they love the mantra, buy term, invest the difference. But it's a broken system, and we're going to see that here in a little bit. And I'm not saying don't ever invest in the market. I have money in the market, but it's controlled. I don't have a qualified plan. I don't have a 401k. I don't have an IRA. I have a brokerage account where I manage 10 to 15 individual stocks that I purchase myself, and I'm not paying a fee to have any of that money managed.
Barry, are you saying that you shouldn't have 100% of your money in risky market investments? Is that what you're getting at? I feel like I should heckle you a little bit with some truth today, right? Just to make sure it's being shared.
Yeah, please heckle because we're told one thing, but what's interesting is that Wall Street and banks are doing something different. Not completely, but you should not have 100% of your money in the market, nor should you have a majority of your money in the market. And we've done a lot of videos on this. I'm going to quickly pull up the Insurance and Estates YouTube channel. Everyone listening, go subscribe to this channel and watch our videos. You'll learn more about this buy term and invest the difference and why you shouldn't have all your money in the market. The Insurance and Estates YouTube channel, it's a phenomenal resource. There are hundreds and hundreds of videos here. Actually, 537 videos
And
here
counting.
put out content.
Yeah.
Cool.
And this is what we're wanting to do for everyone new here watching is just offer some, I guess, somewhat of a contrarian perspective to make sure that you're not just subscribing to conventional ideas to put all of your eggs in one risk prone basket.
Yep. And we're going to get to that human life value formula. You're going to love to see it. Definitely stick around. If you insured your life at the age of 35 and you're in good health, right? Got to be in good health, and you want $1 million of coverage, and you re evaluated your life every 10 years, and you got a 10-year term insurance policy at the age of 35, a 10-year term policy at 45, and so on, the premium cost would be this $254 a year for $1 million of 10-year term coverage. And over that 10 years, you would have spent $2,540. So you think, well, yeah, I'm gonna use term insurance. It's far less money. I don't have to spend $13,750 a year on $1 million of coverage in whole life insurance. But let's keep going. By the time you get to age 85, you would have spent 241,000 of premium dollars to insure your life for $1 million. Once you get to the age of 86, the $1 million, it's gone. There's no more death benefit. But what if we did something different? What if instead of doing 10-year term insurance policies, you did a 20-year term and then you did some 10-year? So the way I structured this is at age 35, said, okay, now you're going to get a 20-year term policy for $1 million. It's going to cost you $417 a year. And over 20 years, you would spend $8,300 for that coverage. You get to age 55, and then you say, okay, I've got to cover myself now through the age of 75 for another 20 years. What's that going to cost, et cetera? Well, the total here is about 212,000. So it's a little less if you do 10 years or 20 years, 20 years, and then from age 75 to 85, you finally do a 10-year term. 212,000. But again, I want to focus on this. At the age of 86, that $1 million is gone. So if you live to 86 or longer, the 212,000 that you paid in premium, it's down the drain. And if you did it every 10 years, the 241,000 you paid, it's down the drain. And Steve, statistically speaking, people are going to freak out about this. Less than 2% of term insurance ever pays a death benefit. What that means is that over 98% of people right now that have term insurance are going to outlive it. I'm not saying don't ever have term insurance. What I am saying if you're planning your future with estate planning, legacy planning on term insurance, you're going to be losing over 98% of the time. What do you think of that, Steve, as an estate attorney?
I've seen it.
Hmm.
I've seen people in their most vulnerable years suddenly don't have any life insurance protection. That's not good. And you're not only missing out on that coverage for the family, but then you also miss out on a bunch of other benefits that we always talk about on the channel. The support for long-term care, the ability to get tax-free income. And I know all those things are things that if people are following the channel, they've heard us talk about them. But it's very tragic, Barry, to your point, that term insurance, it's going to expire most likely for people that are going to be around. And it just gets more expensive too. So if, depending on the kind of coverage people have, and to your example, that next bite at the apple with the renewal term for 10 years is going to be a little more expensive. They have to renew again, and it can become cost prohibitive. And then if there's health conditions that come up, then you could be burnt on that and trying to get another 10-year term. So there's just a lot of issues that are surrounding that.
Steve, I've had people in underwriting, like they've submitted an application, they've died during the application process.
Mm, yeah,
So get it while you're healthy.
yeah.
But let's look at a third scenario. Now what we're going to do is we're going to take the same million and we're going to do a 30-year term policy. So the annual cost at the age of 35 for a 30-year term is $777 a year times 30, it's 23,000. But then when this person 30 years later gets to the age of 65, now we have to do a 20-year term to the age of 85. Most insurance companies don't allow term insurance beyond 85 unless you do what's called annual renewable term. And
Mm,
there's a video that we did that's coming out. It's coming out in about 2 weeks. And I go through the annual renewable term numbers, and you're going to see that it's even much higher than what we're showing here. But in this scenario, it's about 221,000. So
yeah.
you're still paying over $200,000, but if you outlive and you have the insurance expire at the age of 86, again, all that money goes down the drain.
Barry, can I wax philosophical for a second?
Please.
I feel like we're in a culture that does not value peace of mind. In other words, everything I do is supposed to be risk related, right? I'm supposed to have term coverage that's going to expire. I'm supposed to have all my money in the markets. so that I never have peace of mind. Think about that for a second. Whereas what you're going to propose is a hedge. It's a peace of mind creator. And that's near and dear to me. I think people need to pursue some peace of mind in their planning to counter what's going on in the culture.
Agreed. And these clients that have recently passed away, their family received millions of dollars tax free. And I've had many other clients pass away young. I've had clients in their 30s, 40s, 50s, 60s, 70s pass away. And what you're saying is this emotion and family resilience that we want people to have. And the peace of mind, Steve, comes consciously, but it also comes subconsciously.
Yep.
Like, what will you do knowing that you have protection? I tell this story. I had a client that was going through underwriting years ago, getting ready to be approved, and he canceled his family ski vacation. And I said to him, I said, "Why did you cancel your vacation?" He said, "Because my life insurance isn't in place." I mean, that's a real life example. So had his policies been in place, whole life and term insurance, he would have gone on this vacation. He would have created family memories. He would have had peace of mind. And he probably wouldn't have had a single thought of, I'm worried that something's going to happen to me if I die, because he knew he was taken care of. So we don't
Oh,
ever say don't have term insurance. There's a need for term insurance, especially when someone's dealing with debt, to cover debt if there was a premature death, but also if children are still in the house. I had a lot of term insurance, millions of dollars of term insurance while my kids were still at home. Once they leave the house, I let my whole life policies take over, and I own multiple whole life policies. So there is a need for term, but you should not be planning your long-term life and your estate using term insurance, because 98% plus of the time it's not going to work.
yeah. Think about the stressed out parent. I'm going to go back to peace for a second. And the kind of parent that if you're a younger person and you want to become that person that is good to take a ski trip because you know that you got things covered, kind of parent that's not going to be internally stressed out over finances for the rest of your life or uncertainties, even if you got the finances in place, the uncertainties. So
Yeah.
I know I'm,
Yeah. Part of those perils. That's right.
yep.
Well, let's do a comparison now. This is the whole life insurance for the 35-year-old. We already know it's $13,750 a year. So insuring through the age of 85 would have cost $687,000. So if I grab my calculator here and I take the 687 and we minus out, let's just go with kind of the mid number, this 220, 221 of term insurance, you would have paid $460,000 more. And so people are saying, "See, Barry, I told you, you should have term insurance because look how expensive whole life insurance is." Well, whole life insurance is a guaranteed payout. And the $1 million death benefit doesn't stay $1 million. As a matter of fact, when the term insurance in all these scenarios expired at the age of 86 and the $1 million is gone, the whole life death benefit, Steve, at the age of 86 is 3.66 million. And at age 90, it's 4.26 million. And at the age of 100, it's 6.23 million. See, would you spend an additional 466,000 to have your million of coverage turn in to 3.6 million? I think you would, right?
Over a
And
lifetime.
it's
So that's
guaranteed.
spending over a lifetime, which is a priority, right? It's just a priority. And you've got that tax-free death benefit, plus a bunch of other things that we regularly talk about that you can utilize the cash value for, which we're not even touching on at this point.
That's right.
But
So I'm going to show these real numbers. Okay. This is the illustration. We're going to go to the age of 85. 3.5 million, age 90, 4.2 million, Age 100, 6.2 million. And you know what, Steve? Along the way, if this person wanted to use some of this cash, this is cash value, this column, total cash value. The cash is liquid. There is no cash in a term insurance policy. So all day long, we want people to recognize you're guaranteed to pay taxes, you're guaranteed to die. Why not have a guaranteed payout that will go to your family? And the Rockefellers knew this best. They utilized millions and millions and millions of dollars of cash value life insurance death benefit to propel that family generational wealth.
Powerfully so. And just as a hint on that, and they would have those proceeds going into a trust so they get even more control with the emerging generation for those monies, which is a little insight on how they use trusts.
Yeah, I love seeing this growing death benefit. Age 85, 3.5. There's our age 86, 3.6 million number we looked at in the Excel spreadsheet.
Hmm.
And look at this, Steve. You put in another 13,000 at the age of 87, the death benefit grew to 3.8 million. It's $140,000 of increased death benefit on a $13,000 premium. That's like a 10x multiple, right?
Yeah.
Next year, you put in another 13,000, cash value grows to 3.94 million. There's another 10x multiple. I don't know who in their right mind wouldn't want this, knowing the guarantees, the value of the cash, the value of tax-free legacy planning. But let's look at another scenario. What if you're 45? Because I said early on, we want everyone to see something here that will fit their life, right? Whatever age you're at. So this is on a 45-year-old. Same $1 million death benefit, 20,000 a year. It's about 7,000 more 10 years later. Why? Because of life expectancy. The older you get, the higher the cost of insurance. Insurance companies know based on their mortality tables, people are going to live to, a certain age, male, female, somewhere between 85 and 90. The older you are with the increase in insurance costs, the whole life policies still work. So even though this is 20,000 a year, what's happening? Well, if you pass away in year one, you put in 20 grand, your family gets $1 million. If you pass away at the age of 65, you put in 400,000, what does your family get? They get 1.4 million. What if you pass away at 90? You would have put in 900,000. Your family is going to get 3.3 million. Again, this is what the Rockefellers did. They had a portfolio with guarantees.
Yeah, Barry, I'm wondering if we should address the other common objection. I bet you people are looking at the cash value, they're looking at the death benefit, and they might be saying, well, do I get both? Do I lose the cash value? How does that work?
It's a great question, and I'm going to save it when we get into a cash value illustration, because we also want people to see the benefit of using the cash. You might look at this and say, hey, the death benefit's great. Yes, I want a plan like the Rockefellers, but what if I want to spend and enjoy my own money too? So I'm going to answer that question once we get into the other illustration.
Good.
Yeah, it's going to be
Super.
awesome to see the numbers. Here's age 55. So if you start $1 million death benefit today and you're age 55, it's going to be 31,000 a year. Again, it might seem high, but what do you take away from it? You pass away in year one, your family gets $1 million. You pass away at the age of 75, you would have put in 621,000. Your family gets 1.5 million. You pass away at the age of 90, you would have put in 1,086,000, but what does your family get? 2.7. See, there's another myth out there, Steve, and it's really perpetuated by these financial entertainers, Dave Ramsey being one of them. The life insurance company keeps your cash value, or the life insurance company doesn't give you a growing death benefit. They would say, oh, You put in 1,086,000, you die, your family's only going to get 1 million. Most of the time, Dave doesn't know what he's talking about, and these financial entertainers don't really understand a true whole life structure and using mutual companies. But in this case, no, your family doesn't just get the million, they get 2.7. And if you're 65, well, what happens? Premium's 50,000 a year. 50,000 a year for $1 million of coverage. Again, the financial advisor is going to say, you don't need life insurance at the age 65. You're 35, you insured your life through the age of 65. Now you can self-insure, right? Self-insure. You've got all these assets, you've got all this money, you've got all this wealth, your net worth is X. You can just self-insure. Going back to the original question, would you ever think to self-insure your home? You never would do that. And the reason you wouldn't do that is because it would put a lot of pressure on you, your family, your financial resources. Your life is more important. So the same thing holds true. Self-insurance in most cases is a myth. Don't
Yep.
get to the age of 65 and have all your life insurance expire. Because if you do, you'll be feeling pressure that you're going to regret. And we've seen it. I've done this for 25 years. Steve, as an estate attorney, has seen it as well. Steve, before we get into the details here of the 65-year-old, anything you want to share about that?
Yeah, I think as as a trust and estates attorney, you have a different perspective. And what I see with self-insuring is complications out the wazoo because it'll happen, if somebody, passes, is that all those assets then need to be marshaled and coordinated and everything else. So let's say you just had a bunch of assets and you had either tax due, or even if you're just trying to take care of business, you may have to fire sale assets. With like conventional retirement accounts, it's super complicated trying to disperse those to people because of all the tax requirements and everything that just keeps getting more complicated. We're kind of seeing some interesting things with that. And I faced a lot of those complications in practice with regard to the red tape around, trying to pass retirement accounts to a non-spouse. Spouses are okay, but there's just a lot of issues with that. So I would say this is a peace of mind strategy for the whole family down the road to have the liquidity and be able to kind of manage the other assets as you see fit, rather than have to have an emergency where you're trying to sell assets and do all kinds of crazy stuff in the end game.
Yeah, and don't we love that? This is the peace of mind strategy. I love the phrase. And we never want anyone to be in a situation where there is a premature death. I mean, that's a tragedy. And then on top of it, you have a financial tragedy because you didn't plan correctly. Look, we're showing you here a way to resolve it. So the peace of mind strategy is huge. On this 65-year-old, again, as time goes on, at the age of 80, 762,000 would have been paid in premium. He'd be able to leave about a $1.5 million death benefit. At the age of 90, 1.2 million's gone in, but the death benefit's grown to 2.27 million. We always encourage people, start life insurance earlier. You're probably in better health. The cost of insurance is going to be lower, but then the growth because of compounding is going to be a lot more significant. Can you start at 65? Can you start at 75? You sure can. And we recommend you do if you haven't done your planning, but start earlier if you can, because you don't want to be like some of the clients I've dealt with who either passed away during underwriting or never took advantage of it. Said, nope, I'm
Well, most people in our business wish that if they hadn't started early, wish they'd started earlier with policies and things because of just the lifetime benefits that you get as well. So you get to watch that guaranteed growth and that true compounding throughout your life. And it's very much an enhancement to your life, as we often talk about.
Steve, I'm reminded that I hear almost every month, well, let's say every month and almost every week, someone saying to me, Barry, I wish I would have done this 20 years ago. Don't be that person. I sent out an email recently and said, don't be that person. Get started. We can help you. Now, this is going to get fun because I promised we were going to look at the formula for all of you out there to determine your human life value. And maybe a million's too low, right? So if you need 5 million, well, you're going to double all the numbers. You double the premium amounts, you double the numbers. If you need 10 million or 20 million, you can do the math. Here's the formula we've all been waiting for to determine human life value. And Steve, the formula is this. You take your age, the age factor, times your income, and that equals your human life value. So let's run some examples. If you're 30 years old, meaning you fall into this 18 to 40 age range, and you're earning, we're going to keep it simple, $100,000 a year, we would times that by 30. You have a human life value of $3 million. What that means is the insurance companies, all insurance policies combined, they would allow you death benefit up to 3 million. It can be term insurance, whole life insurance, universal insurance, or a combination, right? But you couldn't go beyond 3 million. And people say, well, if I'm willing to pay for 4 million or 5 million, why is my human life value only 3 million? The way insurance companies work, I mentioned this a little bit earlier, it's all based on mortality tables and life expectancy. And it's a replacement of income. If you went down to your homeowner's agent's office and you said, hey, I know my home is worth a million, but I want to insure my home for 2 million. I'll pay it. I don't care. I just want to insure my house for $2 million. They're going to say, no, we're not going to do it because your home's only worth a million. In this human life value formula, if you have 3 million of human life value, they're only going to allow you up to 3 million. Now, we know your spouse is saying, hey, you're worth billions. You're worth billions, right? But the insurance company, they do have a limit. So if you're 50, in between this 46 and 55, let's say you're 50 years old and you're making 500,000 a year, they're going to give you a multiple of 20, which means you have a $10 million human life value. What we recommend is insuring your life for maximum human life value. You don't need to do it with all whole life insurance. You can do whole life and term. And I call this the security of maximization. Because if I did ask your spouse, hey, how much life insurance do you want on your spouse? I hope they wouldn't give me a number. Steve, I hope they would say as much as I can get, right? Give me as much as I can get. Well, that as much as I can get is called human life value. And when you have the maximum human life value, you have that security. That's why I call it the security of maximization, knowing you've got peace of mind. Look, I have as much life insurance as I can get. My family's going to be well taken care of. But all of you listening, go through this little scenario, determine what your human life value is, and then what will it take for you to get there? We want to have that conversation with you. Whole life insurance absolutely should be a part of it. But you might say, okay, if my human life value is 10 million and I'm 35 and $1 million of whole life insurance is 13,000 a year, I'll put, 25, 26,000 a year towards my human life value. And that means I've got 2 million of whole life. I still need another 8 million of coverage. I can get that in term insurance. And if you're 35, you've probably got kids at home. That would be a smart thing to do. You could do a 10-year term policy. You could do, 8 million of 10-year, 8 million of 20-year. It can all be broken down differently. And do you have to get your full human life value in place? No, you don't. But get as close as you can. We want it to make financial sense for you. And this is what the Rockefellers understood. They wanted to maximize as many family members as possible. So me now, I've got 6 children, 1 granddaughter. I'm going to keep adding policies that I own They're going to be on my kids and grandkids. I will control the policies. I will control the cash value. When one of those individuals passes away, the death benefit goes into a family trust. And then when a new grandbaby is born, there's another policy that started. And this is what I hope you're beginning to see. The perpetuation of family wealth. That's a very simple way to think about it, but it's exactly what the Rockefellers did.
So people should be encouraged. You're valuable. You need to understand your value. Do the calculation. Take a snapshot here, guys, if you want to do your own calculation later. And think about the long game. This is a long game idea, right? If you start earlier, it's an even longer game and more rewarding. But even if you hadn't been able to get started, there's still a ton of rewards in understanding this concept for people.
Steve and I have talked about a lot of these things in some books that we've written. Steve has a book called The Intentional Wealth Effect, right? Be intentional about creating wealth and legacy. I have a new book just came out this year called Live Rich, Die Rich: How to Use Cash Value Insurance as a Wealth Tool. So go to Amazon, get the books. It's going to be well worth your read. And I love what Robert Kiyosaki said. He said and taught a lot about financial literacy. The more literate you are when it comes to financial knowledge, the better decisions you're going to make. This is what, again, what the Rockefellers did. They used education to perpetuate family wealth. Now, this is going to be fun. Do you remember being in grade school, Steve, and getting one of these, like a hall pass or a permit?
I'll pass. Yeah, I do actually.
Felt like the king of the hill, right? It's like, hey, I'm
Yeah.
free. I can do whatever I want.
Or maybe take a little longer getting to where you need to go because you got the pass, that kind of thing.
Yeah.
Yeah.
Well, these policies allow you to have a permission slip in your financial life. What do I mean by that? What I'm going to do is I'm going to pull up this truth concepts calculator. And what I'm showing is a person at the age of 70 who has $1 million portfolio. We see that right here. And again, all of you listening, use your own numbers. Maybe at the age of 70, you'll have a 10 or $20 million portfolio. But I'm using these easy round numbers to keep it simple. You can do the math to figure out your own situation. And this 70-year-old Steve has no life insurance. They took their financial advisor's advice. You can self-insure. You don't need life insurance. You're 70, you've got $1 million of assets. And he's going to invest a little bit more conservatively. We're showing a 5% earnings rate on the $1 million. And he's going to withdraw the old traditional, what's called Monte Carlo rate of 4%. So earning 5, withdrawing 4. The Monte Carlo rate says you can take 4. It's more like 2.8 today, but I'm using the old traditional number to get a little more income. And off $1 million, that's 40,000 a year. Okay, so he's pulling out 40,000 a year. He's paying some tax on the gains. We see that here. And then we have net spendable income. So over the course of 21 years, starting at age 70 through the age of 90, he'll be able to spend and enjoy 660,000. We see that number here at the bottom. And his $1 million still earning 5%. We're not factoring in market volatility or fees. We're just keeping it very simple. His portfolio grew to 1.35 million. So he dies at 90, and we add these two numbers up. He would have spent and enjoyed 660,000, and he leaves his market-based account to family 1.35 million. He's able to leave about 2 million overall, right? He spent 660, leaves 1.3, total of 2 million. But now we want to look at this person, same age 70, and he has life insurance. And we're going to do a comparison. But what this person did, he only put 800,000, where he's got an $800,000 portfolio, not a million. You think, well, why 800,000? Because what this person chose to do, he chose to take 8,000 a year and buy a life insurance policy, only $8,000 a year. And he funds the premium for 25 years and then he's done. Okay. So I want everyone to think about this. When you buy a whole life policy, you can fund it to the age of 100 if you want to, but you can also choose to stop funding later in life. If you want to fund for 10 years and be done, we've got a policy for that. If you want to fund to the age of 60 and be done, we've got a policy for that. You want to fund to 75, we've got a policy for that. In this case, he funded for 25 years through the age of 60 and didn't put any more money in. So his total contributions, 8,000 times 25 is 200,000. Okay. At the age of 70, there's $1 million death benefit. But we want to show the age of 90 because we want this to match. There's a $1.78 million death benefit. Well, because he had a death benefit, what did he do? He said, I'm going to spend and enjoy not only the interest I earn on my 800,000, I'm also going to spend and enjoy my principal. So he's going to spend down the 800,000. And now his income, instead of 32,000 a year, it's 58,000 a year, Steve. So he has more income, and over that 21-year time frame, he would have spent 1.22 million. That's almost double the 660,000 that the age 70 person with no life insurance spent. So now let's do the math. 1.225 million is what he was able to take for income. What was his death benefit? At the age of 90, 1.78 million. We add these two numbers together. He gets 3 million total. Steve, it's $1 million more than the person that just had market-based money and no life insurance. So I'm proving it out here mathematically. When your financial advisor says to you, self-insure, whole life is a bad investment tool. Don't ever get whole life insurance because Dave Ramsey said the cost is too high. It's wrong. It's just flat out wrong. I'm showing you right here and proving that the Rockefeller method gives you $1 million more in this scenario. And what if you're the person that's like, hey, I've got a lot more money, I've got a lot more net worth, my human life value is 10, 20 million. This 3 million could turn in to 6 million, 9 million, 12 million, 15 million, 18 million. This is proof with real numbers that the Rockefeller method, it works.
Powerful stuff, and we see it every day. If you guys are new to this, just keep digging into the knowledge base that we've built. Barry's been a big part of that, and keep understanding this. And of course, we always invite people to look at your own numbers as well when you're ready to do that. So we have links and things for the ability to schedule, which wherever you're watching, if you're watching recorded later, then we'll have links there. And of course, invite you to do that.
Yeah, we got about 5 minutes left, and then we're going to take any questions if people have them. Think like the Rockefellers. Risk management. They had guarantees in their portfolio. Access to tax-free money. One final scenario I'm going to show before we wrap up. Access to tax-free money. Living benefits. See, the Rockefellers weren't just planning on the death. They're saying along the way, what if I have a life event, chronic illness, terminal illness, critical illness? What if I become disabled, one of those perils of poor health or loss of health? What can I do in that event? These policies, Steve, provide living benefits where you can tap into your own life insurance death benefit while you're still alive. You could even sell your death benefit to a life settlement company. It's called a viatical settlement. If you don't want the death benefit and you just want the cash, sell your death benefit. That's a way to spend and enjoy your own death benefit while you're alive. They obviously had a permanent death benefit, many of them. This was the perpetuation of the wealth, asset protection, and estate planning. Steve, before we get into our final illustration example for accessing tax-free money, anything you want to say relative to this?
Sure. This is another area as an estate attorney that I watched in so much detail in so many people's lives. Planning for health in the older years is a huge mega industry in and of itself. Um, people think, they're going to protect their assets and try to do Medicaid, and they have all these theories about it. The best possible scenario is to be able to have a pool that you can draw from if you need it for future chronic illness, critical illness. We all know without even demonstrating it that those costs, those healthcare costs, just continue to be a problem, skyrocketing for families, and can certainly clean out a person's self-insuring assets pretty quickly. So definitely an area that came to my mind originally today, that I mentioned, critical illness and things like that, or living benefits. And these kinds of things are a huge part of the living benefits that people get by adding permanent cash value insurance to the mix. Something that the pundits and entertainers, they seem to forget about this aspect when they're shooting down using these kinds of assets.
And Steve, what's so interesting about these financial pundits, these financial entertainers, is it's a lot of opinion. They rarely, if ever, show real numbers. Today, we're showing you real numbers, and we have proven it over and over, not in just this video, but in many videos. We've done a lot of debunking. So go in and get educated and look at the numbers because the facts are the facts. We're seeing facts today. We're going to wrap up with one.
Hey, Barry, one more point on that is, a lot of the stuff I think, unfortunately to me, seems like, hey, this is good for you guys. I'm going to go do something else, right? So if I'm a mover and a shaker and an entertainer, I might say, yeah, use this particular, goofy, legal website and go get your documents and stuff to self-help. But then I might go hire a high-powered lawyer myself to do my own stuff, which I feel is kind of what tends to happen. So I just want to put you guys in the driver's seat in understanding this stuff. And I know that's where your heart is too, Barry.
Always doing the right thing for clients. It's so important because we want to make sure that people really are getting these benefits. Well, in my last scenario here, this is a maximum cash value policy. And we're minimizing the death benefit. So we would call this an infinite banking design. This is on a 35-year-old. If I go to the original illustration on our 35-year-old where we were looking at that $1 million, notice that there is no cash value in the first year because it's a death benefit play, right? But if we put that same 13,750 into a maximized cash value policy, of the 13,750, 11,436 of this is in cash. And the death benefit's 355,000. So by lowering the insurance death benefit, more of that 13,000 can go into cash value. So if you double this and take it to say 27,000 a year, your cash value is going to be about 23,000. If you quadruple it, right, all those numbers will come out. This is a very linear example where you can use multiples to see where your numbers might be. In a cash value situation, there are two things that we're primarily looking at. One is using the money early on. Maybe you want to take a policy loan, you want to invest in a business, you want to go buy some real estate. Well, there's more cash here, so you can leverage against the cash value as an asset, go buy another asset. And the cool thing is your total cash value is still working for you. So if you take an $80,000 loan here in year 6, you're still earning interest and dividends on your 86,000. And we've done many, many videos about that. I'm not going to get into the details.
Well, Barry, I do want to mention though, I want to give you a little plug. Barry looks at the goals of the client and then will design the percentage of cash value to whatever that should be. There's a lot of people, I think, in our industry, unfortunately, that have a set thing they do. Maybe they do 60% cash to base, right? Where Barry, I know that you look at that. If someone really wants cash value, you'll try to design that policy to where it's 90% plus cash value, lowering the death benefit. So if you guys are new to this, just understand that you do need to be aware of the practices that people are using to put together, you know, a strategy for you. And you want somebody that can do what's needed rather than just stick to a set sort of locked in way of doing things.
I'm glad you said that. And everyone listening, you want to determine, is it more important for you to have more death benefit, or is it more important for you to have more cash value? In my life, I have both. I have my cash value policies, but I also have whole life that is focused on legacy and death benefit only. So you can have both, but drill down at least initially what you want to look at. We'll make sure that whatever your goal is, we're going to design illustrations that meet those goals. Part two of this is the income, tax-free retirement income. So I ran the 13,750 through the age of 60. And then we see here at the age of 61, premium zero. Steve, there's no more money going into the policy. But notice the cash value continues to grow. No premium going in, cash value always increasing. And at the age of 70, now this person wants to start taking out 78,000 a year. How much did they put in over that time frame through the age of 60? They put in 343,000. They're taking out 78,000 a year through the age of 90. And this is awesome to see. We take 78,000 times 21 years. They're able to pull out $1.63 million completely tax-free, and they only put in 343,000 into the policy. So death benefit, Rockefeller strategy, it's amazing. Cash value, infinite banking strategy, it's amazing. What we encourage either way is that you look at your own numbers, see how the Rockefeller secret will work for you. It's been awesome to go through this. Steve, I've done this for 25 years. I see these numbers still today. I get fired up. I mean, these numbers are amazing. And we want
Yep.
people to experience this in their own lives.
Yep. I get fired up too. It's always great to see you put this stuff into tangible form for people to understand, Barry. And encourage you guys watching, if you're ready to look at your own numbers, do that. Keep learning regardless. Keep watching the videos and keep plugging in to understand this because it is a contrarian set of ideas that we're really passionate about you guys understanding. And if you're new, encourage you just keep plugging in. If you have comments, and we don't have any questions, so we must have been really thorough today, which is great. If you're watching this on YouTube later and you want to leave comments, we're happy to answer those in pretty quickly. And if you've had some success with this, we'd love to hear about that as well. A lot more to learn as far as trust, so we didn't get to scratch the surface much on that, but we're passionate about that as well. But we appreciate you guys being here, and we're going to keep doing these live webinars monthly. So stay tuned for future topics. With that, appreciate you guys joining us, and we look forward to seeing you in the next one.